I'm Charlotte McLeod with investingnews.com, and here today with me is Will Rhind, CEO of GraniteShares. Thank you so much for joining me. Great to have you on again.
Yeah, thank you, Charlotte. Great to be on. Thanks so much for having me back.
Of course, really good to be catching up with you. I was looking back at our previous interview, and it was actually all the way back in March, so there's a lot to go over since then. I think one of our topics at that time was the Fed's capacity to raise rates. And of course, when we were speaking at that time, we just had the banking crisis. And I think everybody was thinking, well, the Fed really can't go any further or very much further. So I want to check in on that. We have actually seen the Fed raise rates. And I'm wondering your thoughts on how they've been able to get as far as they have been, given I think many people thought that this wouldn't be the case.
I think particularly around the banking crisis that, that was contained for now, let's just say, with obviously the combination of banks being taken over or banks being absorbed into much larger organizations like the JP Morgans and this world. So yes, there was definitely some significant concern at that time, but the market was able to move past that. And I think that plus other factors provided some headroom to raise rates. But I mean, again, we're not talking about a significant uplift from where we were last time.
Very good point. We haven't actually risen a huge amount since that previous discussion. And, coming up later this month, we have the Fed's next meeting. So, of course, we've got to talk about what we might see there. It sounds like the consensus is that we will see rates stay flat. Wondering your thoughts, and maybe if we look beyond this meeting as well, because we should also be considering what may come later this year.
Yeah, I don't at this stage have any reason to believe that it will be anything other than I think what the market expects, which is no news, specifically around the hikes. So I don't think there's going to be much coming out of this particular meeting. And I think even towards the end of the year, despite some of the rhetoric we've heard from some of the governors, again, I only see the probability of a rate hike happening if clearly there's some data to suggest that inflation's on the up again, or something that provides some catalyst for them to raise interest rates. But I do think that by and large we're at the top of the cycle, and we are kind of on the way down, albeit, not sort of immediately.
And in your view, is the soft landing scenario, is that within reach at this point?
Definitely within reach. I mean, think about where we were at the beginning of the year where, really everyone was calling for like an imminent recession or worse. That hasn't been the case. And I think that, so far the market has been very resilient. Earnings have stayed strong, and the economy is doing fine. I mean, clearly there are areas for concern, particularly around real estate, etc. And so that is one area which could spark a broader concern or even recession. I think for now it's okay, but providing I think that we don't have a big dislocation in the part of the economy, section of the economy, I think it is on the table.
Yeah, it's been very interesting to watch that narrative progress to where we thought definitely it was going to be a hard landing to now more, okay, maybe not. Maybe it is actually going to be fine as people have been telling us it will be. So on that note, I want to also look at what's going on with gold, because when we talk about gold, often what I hear is, it's kind of tied to, wow, the Fed will turn around. There's going to be something dramatic happen, and this is what's going to propel gold higher. But if we're heading into this scenario where maybe we don't see that happen, what do you see coming for gold?
I think more of the same that we have seen, which is it's been very resilient around, for the last 6 months or so. I mean, clearly gold has performed well this year, all things being equal, but I think the pricing's been very resilient against this backdrop of, rising rates. And clearly last year, gold held its own when pretty much everything else lost money. One thing to think about, I think, is that gold is poised quite nicely here, in my view, because the prevailing narrative that you hear sometimes is that when the Fed starts cutting rates, that's going to be really good for stocks and therefore really bad for gold. I'm not necessarily sure that's the case. I would want to think about, what the conditions might be to cause the Fed to cut rates. And I think that, cutting rates probably means that we are either heading for a recession or we're in a recession, out and out recession. And so therefore, I'm not sure that is actually the market where stocks go higher. And it is a market where we see a traditional flight to quality or flight to safety, and people come in and buy gold. So I think gold is actually sitting quite nicely here.
Yeah, and that would track well with kind of the opposite scenarios that we seem to be seeing in the markets lately, where things that usually mean one thing start to mean something else. So very interesting for gold. I wonder, of course, the Fed, we like to talk about the Fed when it comes to gold. That's important. Other factors that you're watching for gold right now, though, that people might be forgetting as they focus on the Fed.
Well, I think the big one is the dollar and this really trend that we've seen kind of from, frankly, about now a year. So in summer last year when the dollar peaked and really has been on a downward trend, since then. And gold, when you think about what is the best hedge against the falling dollar, gold is really the asset that people go to, and certainly one of the top ones that people think about when they think about what is a hedge to a weakening or a falling dollar. So I think that's a big factor. Again, part of that is super macro trend that will be very much dependent on what happens with interest rates and inflation. But that's something as well that's been very supportive of gold, certainly over the last year.
Yes, and when it comes to the dollar, I've started to hear, particularly over this past summer, a lot of narratives around the slow kind of move toward de-dollarization. How do you see that playing into what's going on with the dollar? Is that something you're factoring in?
No, definitely. I think it's clearly something that's happening. The big question is not whether it's happening or not. The big question is just how much impact it will ultimately have. So that's really the big question. It's obviously way too early to really say or to know any kind of real impact. Although clearly when it comes to gold specifically, we note that central banks continue to be big buyers of gold. The Q1 this year was a record in terms of central bank buying. So that is part of de-dollarization. In other words, diversifying foreign exchange holdings into alternative foreign exchange holdings in US dollars, I should say, into alternative currencies, of which gold is clearly in that mix as an alternative to the dollar.
Right. And you mentioned, central banks being big buyers of gold. I think we've been hearing a lot about that. You also have a good handle, I think, on kind of retail investor demand for gold with the ETF background at GraniteShares. So I wonder, what are you seeing from the smaller buyers of gold? Is there that interest as well? Or people maybe a little bit less interested when we're at this historically elevated level?
I think the big trend, or at least the trend this year, has been that from an investment perspective, people have been largely withdrawing money from ETFs. So, gold ETFs have had outflows, broadly speaking, year to date. And I think that goes hand in hand with the narrative that people well positioned for an imminent market, collapse or recession at the beginning of the year that didn't materialize. And so people have kind of been caught a little bit from a performance perspective on the sidelines and have been trying to chase the market up and therefore trying to reallocate, as we go along. So we have seen some, let's just say, muted investment demand for gold, but I think that goes hand in hand with clearly what's been happening in the broader market, which is people have missed the rally or at least been underinvested and therefore have had to chase the rally upwards from a performance perspective.
Right. I think it's good to have that context there. And so, I think our audience probably knows GraniteShares best for its gold and other commodities ETFs. But we're going to talk today about some of the new products the company is offering, which are single stock ETFs. So you have some recent news around there. But before we start talking about that, I want to ask you to explain exactly what single stock ETFs are and how they work. Because, I think people generally, when they think of an ETF, they think, okay, this is a way to get broad exposure to a sector. So how does it work when it's focused on a single company?
Yeah, no, absolutely. So put simply, it's an ETF that provides exposure. Typically, it's leveraged exposure, although it can be short or short leveraged or leveraged short exposure to a single company. So in a way, it's funny because when you think about, GraniteShares' product line, it's not too different from what we already do because gold is a single underlying or platinum's a single underlying. And so you have had that for many, many years in the market and other commodities, single commodities as well. So extending that to single stocks, isn't really a big leap. But yes, it's a way for people to have leverage exposure to individual companies within an ETF. So all the benefits that an ETF brings, but instead of getting exposure to a broad index where you might have 100 companies in it or 500 companies, it's leverage exposure to one company.
All right. And so these would probably be for a person who maybe has a strong conviction one way or another on a particular stock.
Absolutely. It's for high conviction, clearly the highest conviction investments you can make because it's A, on a single stock, but B, typically leveraged on a single stock. So whether you're thinking about, going over the earnings season or you have a particular view on the movement of the stock, be it on the long or on the short side, it's a way to implement that view with a level of conviction that clearly goes beyond just buying the stock itself.
Right. And I like the comparison you made to ETFs focused on, gold, because it isn't actually perhaps that different than that. You're focusing on a single element there. So we'll talk about the new single stock ETFs that GraniteShares has launched. So I believe they're focused on some of the very popular stocks right now, like AMD, Tesla, NVIDIA. So these are stocks that may already have some volatility within them. And I wonder how you would recommend investors approach these products. How should you be trading or investing in these products?
Well, in a way, so you think about the ETF universe or the ETF portfolio that we offer. So we offer commodity-based ETFs, so that's on single commodities. We offer equities. We offer income-based portfolios. And then we offer these levered single stock investments as well. So really trying to appeal to not just the buy and hold investor, but the short term or the shorter term, more active trader or active investor. And so with a lot of these individual companies, it's been kind of a fascinating story because this year, clearly the action, if you want to call it that, in terms of performance has been in these large tech names. And that's largely what we have delivered to the market. So if you look at NVIDIA, which is probably the star of the show in terms of what we offer, our NVDL, which is the 1.5 times levered NVIDIA, is up around 400% year to date. So that's one of the best performing ETFs in the market. Now, obviously, that has taken advantage of the NVIDIA AI story, the amazing performance of NVIDIA, but with a turn of leverage on top, it's really added to that performance. But we have companies like Tesla, where we offer 1.75 times exposure to Tesla, and then on the short side as well, to other companies like Coinbase, which can be a proxy for crypto, or Alibaba, which can be a proxy for China or Chinese tech more specifically. So there's a range of different companies that people can get exposure to.
Yeah, that's pretty interesting. So a little bit more high risk, high reward when it comes to, the ETF sector there. Really interesting. So would you consider launching more of these in the future? Is that in the cards?
It is. It's a really active segment of the market. So I think that, particularly in these conditions where I think it's fair to say that people perhaps don't have like a huge conviction. I mean, and when I say people, I mean the market probably in terms of direction one way or the other. And we have been in a volatile market where we have big up days and big down days. And so it does lend itself much more to people who are more tactical and are very comfortable being more tactical in this market. And so we've seen a huge demand for these products. Now, obviously, it goes hand in hand, but there's already a huge demand for those underlying stocks. I mean, we're talking about some of the most popular stocks in the world that people know and people own and have a very strong view in terms of those stocks and when to buy, when to sell. And that, I think, has just carried over into the leveraged single stock portfolio that we run and, providing people with some inbuilt leverage, or if it's short, indeed the ability to go short with an ETF, which is very difficult to do, in ordinary circumstances.
Yeah, I think this is a very interesting option that people might want to consider. So thank you for going over how that all works. Just before we wrap up, I want to make sure to touch on platinum as well, because this is a metal that we've spoken about before. And I remember you were feeling bullish on this sector. So recently we had the World Platinum Investment Council come out with its latest quarterly report. They're now predicting a deficit this year, I believe, of above 1 million ounces. And I think that'll be the highest on record if it ends up happening. So want to check in with you on platinum and your feelings toward the sector, because I know we have prices, despite this potential deficit, kind of hovering in a range bound kind of territory.
That's right. And platinum's been doing that, for a few years, which makes it, again, great if people are willing to trade it a little bit, because it has been so range bound. But I think what we're really all interested in is when does it break out of that range, and when does, platinum really start to accelerate to the upside again? Of course, many people that have followed precious metals for a long time will remember the days when platinum traded at a premium to gold, and indeed became so much the case that in the English language, we associate the word platinum with above gold. So a platinum credit card being better than a gold credit card, et cetera, et cetera. So we haven't seen those days for quite a long time, and we were waiting for those days to come back. But I think, again, I think that I remain positive on platinum. The deficit is clearly a positive for those investing in the sector. I mean, when you look at commodity fundamentals, if a commodity has more demand than it has supply, then, all things being equal, that should be a good thing. I think what's been challenging for platinum is this sort of, recessionary narrative, or this, economic malaise that seems to be creeping, but particularly applying to China, because that's, obviously a big market for platinum, exhaustive demand. And I think everything on in the commodity spectrum that's largely linked to the Chinese story has been affected by their economic woes this year. And so I think we need some signs of life from the Chinese market that, the stimulus packages or more stimulus that will be injected surely between now and the end of the year will spark some kind of a recovery. But now, the price of platinum has come down, fairly significantly down towards the bottom of these ranges that we've seen over the last few years. Not as bad as palladium, which has been, absolutely hammered, but still, platinum prices are down versus where they were.
Really interesting. And, you mentioned palladium. I wanted to round out our discussion on precious metals by hopefully looking a little bit about palladium and silver, see what you see coming in 2023, because it's always good to get the full look at the sector there.
Yeah, I mean, I think the key for the PGMs, or at least for platinum and palladium, is, a more robust economic footing globally. I mean, auto demand has been strong, and clearly that's the biggest source of demand for both of these metals. So continued strength from the auto sector will benefit those markets. A deficit situation in platinum also helps. Palladium was in a deficit as well, although perhaps not so much now. But I think really it's a larger economic story. They're much more correlated to the business cycle, and so a big pickup in economic activity should benefit both those metals, but particularly from China. Silver is similar, but silver does benefit from the fact that it is a monetary metal as well, and so that's why I think you haven't seen the price of silver fall apart, and it's been a little bit more resilient around the sort of $23, $25 an ounce level. So a little bit like gold, it's sort of playing more in the same sandbox as gold at the moment. And silver has the benefit, like platinum does, of course, that it's used in a lot of the new technologies, particularly obviously in the case of silver, solar, and other renewable technologies, which are going to be so important for the energy transition over the next few years. So from that perspective, there's a lot of things to be positive about. But I think, again, some of the sort of economic malaise that kept the price of platinum and palladium kind of in constraint has also affected silver with its pro-cyclical properties.
Yeah, certainly it becomes easy to see how they're all interconnected in their own different ways. So that wraps up everything I was wanting to know from you today. But did you have any final thoughts that you would leave the audience with?
I think that things are probably a little bit better than people think in terms of the market. I think that we could end up probably higher than where we are today. Not sure there's necessarily any massive surprises coming the rest of this year. And I think gold is in a good position because of this narrative, if you will, that when the Fed starts cutting rates, I think that's actually bad news for the market, not good news. And I think they'll stimulate some investment demand for gold in that particular circumstance, which hopefully will help in terms of moving the price higher.
All right. I think that's a good takeaway to end on. So thank you so much for coming on to go over what's happening in the precious metals markets today.
Thank you, Charlotte. Always a pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Will Rhind of GraniteShares. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.